Good afternoon, everyone. Thanks for joining us today on a panel about impact investing. It's notable that we're sitting here in 2024 and impact investing comes right up after the private markets, private wealth conference. So it must say something about the value that impact is delivering, and that's something that I'd like to talk with you all about today. So I'm joined to my left, Greg Schell, Head of Inclusive Growth Strategy at Goldman Sachs Asset Management, Caroline Greer, Managing Director at the Commonfund, Dawn Powell, a Principal at StepStone, and Cynthia Muller, Director of Mission Investing at Kellogg Foundation. I'm sorry, Cynthia, Dawn on the end there. My apologies. Cynthia, I would like to start with you because you're at a foundation, and a question for all the panelists too. How do you define impact investing? How is that similar, different from ESG, sustainable investing?
Sure. Hi, it's great to be here with these wonderful co-panelists and to be with you all here in the room and online. So I'm with the Kellogg Foundation. We're about an $8 billion private foundation. And about 16, 17 years ago, our foundation launched our impact investing program, which we call our mission-driven investments program. And for us, the definition of impact is really around intentionality and the degree to which you are trying to achieve some type of impact, whether that is affordable housing or if that is entrepreneurs that are supported. But the degree in which you have that embedded within your strategy shows us, well, it actually directly connects to the KPIs that we'll be tracking along with the performance. So for us, it's really about where is the intentionality, to which degree, and that might mean a partnership with a nonprofit too. They have their own in-house built infrastructure. But it just gives us a little bit of breadth to engage with the full ecosystem because we don't know. We don't know where it's ultimately going to land in terms of management. I'm excited to hear Dawn talk about it because I know she's got a really good perspective on this. But again, for us, it just goes down to intentionality and to what degree are we actually achieving it.
Dawn, how do you define impact investing?
Yeah, great to be here with everyone. I completely agree. The two words in impact that are most important are intentionality and measurement. And you're targeting a specific social or environmental outcome that's different than ESG, which is just trying to understand how environmental, social, and governance factors materially impact your investment case. Those can be risks or opportunities, and that's just good investment hygiene across any investment. So ESG is broad, impact is very tailored and focused, and we've seen that the evolution of this space has just grown to an incredibly diverse and broad opportunity set. We're tracking over 1,000 funds in our database that are targeting specific impact outcomes and measuring those outcomes.
Caroline?
Yeah, we also distinguish impact investing from ESG, and I would say that our clients very much care about the intentionality. They tend to be not so much focused on those direct, localized, direct investments and more allocating through managers and in order to realize the impact that they're looking for. So that has sort of pros and cons to it. The pros are that you can have multiple layers of impact because you can be investing, for instance, in a underrepresented minority manager who is then investing in businesses that are led by underrepresented minorities. So you can have that sort of waterfall effect and have a double line to your outcome. But we're not really involved in those localized projects.
And Greg, how do you define impact investing?
Let me just join my fellow panelists by saying thank you for having us, but this is the penalty of going last. All the good words have been taken, but let me say this. I've always thought of impact investing as really representing the trinity of driving commercial and on purpose commercial opportunity to expand affordability, access, and quality. And as we've heard from Dawn, for the betterment of driving improved outcomes. I think what was really important to understand that what we believe as impact investors is generally all capital outlays have some kind of impact. It's job growth or what have you. But when you do that on purpose and you see part of your purpose exploiting commercial opportunity by doing things that are positive that have positive externalities, then you have something real. And when you can do that at scale, I think you create lots of winners. And I think this is probably the highest ambition that we could have for capitalism, Patrick, which is that it spins out benefits for people. I think in many ways we've kind of lost the plot here, that with the idea that you ought not think about whether the capital that you have a chance to send out in the world, that you're indifferent to its impact. And I think we as impact investors are not indifferent. We actually think there's something that you can do to cause some positive outcome, and to track it and to measure it and to report it is part of our purpose to demonstrate to our constituents, I think.
How have you seen this space evolve over the last 12 months? I wrote not too long ago about an heir of the Walton family fortune dedicating $900 million, 90% of a $1 billion fund to mission-aligned investing, so impact investing. Are you seeing more foundations, more family offices thinking about going impact investing?
Yeah. I had the wonderful opportunity some years ago to co-found an impact investing strategy at a large alternative asset manager. And I thought when we first started that fund, Patrick, that this impact investing thesis would go one of two ways. Either A, it would be subsumed by regular way investing and people would declare it as the way you needed to think and believe, or it would continue on its path to sort of taking share, but mostly still be a tiny part of the world's global capital markets. And a funny thing has happened along the way, which is in terms of sentiment, I think we're in many ways in a place where there are many crosswinds and headwinds for the impact investing thesis. But from a fundamental perspective and where growth in the economy is actually occurring, I think the fundamentals that govern impact investing and why we're so excited have never been stronger actually than right now. The proof points are all around us, and I think the opportunity set continues to widen and expand. And I think investors make the mistake, as do allocators, to think of us as the center of this plot line. We're not. It's the companies that we're looking to invest in. And on that basis, there's a little bit of a split screen, right? And so when you think about how it's changed in the last 12 months, the predicate for impact investing has strengthened and maybe dramatically, actually. Sentiment continues to lag, and I think that's an interesting phenomenon, actually.
So can you just a quick follow-up on that? Yeah. Sentiment is lagging, but what was the point you were making just before the predicate is
that the fundamentals, the things that are driving global economies and helping these companies to be attractive investments, that actually is as strong as it's ever been in my judgment. But sentiment in terms of whether this is a commercial thesis and so forth, it continues to plague the sector. And I think that's an interesting duality, is all I wanted to say.
Caroline, can you talk a little bit more about the specific ways that Commonfund is thinking about impact investing, like picking managers, for example?
Yeah, for the most part, at the moment, most of our clients are looking to have impact at either a gender or a racial or ethnic basis. And so it's really, and there might be other elements of impact embedded in those, for instance, women that are single mothers, et cetera. But they're looking to allocate to, say, managers that are female-led, that are investing in female-led businesses, or allocating to African-American or Latino managers that are investing in African-American and Latino-led businesses. We also have, outside of the US, we have a client that is African and investing in African venture capital in order to promote the development of more entrepreneurship within the continent. And that's a very broad mandate and a very broad way of approaching it, but all of their underlying managers are measuring the KPIs of their impact. And it has become almost de rigueur for those managers to do so, given the fact that they receive so much money from development funds, national and international development funds. So that's the primary way that we end up doing it. There are, of course, many other approaches.
Cynthia, do you have any thoughts on approaches?
Yeah, I mean, it's really exciting, and I love these two questions because I was just reflecting on the evolution of this work. And, 15 years ago, shoot, even 20 years ago, I mean, it was very sporadic, right? It was like a lot of self-identified individual funds, or maybe like groups of practitioners like CDFIs, community development financial institutions. Now you see GPs percolating all over the space across asset classes. Most notably, it's been in VC, I think because it's the easiest. But for instance, right now, we're looking in private credit, and we're trying to find managers of certain scale, and it's been a little more challenging. So we're seeing a lot of growth on the opportunity side, but it's a little patchy, right? So you'll see some like affordable housing. They've got it down. Like, you can find an affordable housing deal, but if you want to find, certain hedge funds or other asset classes, it's just going to be a little bit more work. But I also think that's just where we're at as an industry, as people become more attuned, and I think more consistent across how we talk about what impact is and what it isn't. And then I also think, in addition, investors are changing how they approach. When we first started, people were just kind of had this nice little carve out kind of state over there, and largely people still do. But at the Kellogg Foundation, I work under our CIO, Carlos Rangel, and our VP of Program and Strategy. And what's really nice there is that we can leverage the broader platform of the foundation, but yet still drive the main mandate of the program. And so we're seeing a lot more of asset managers take on that approach, whereas before it would be, you had this carve out and neither team talked to each other, like, at all. Different systems, in fact, and where I've been talking to more colleagues where it's starting to get more integrated, because I think the endowment side is seeing more benefit and kind of understanding this materiality around the impact and what does it mean. And hopefully AI and all the data will tell us that in a year or so. But I think for the most part, we're just seeing people who are already committed to this understand the benefit and really are truly seeing this as an investment opportunity, are tripling down in those spaces where they can. And then others are kind of waiting for things to play out in the industries and the sectors that they're interested in.
Are you seeing more foundations going almost strictly mission impact investing?
I'm seeing, it depends on the size. Mm-hmm. So yes, there have been a few foundations, more than a few actually, that have been allocating $1 billion to impact, which might be their entire endowment. Our colleagues at Ford Foundation, which is a little over $10 billion, they've got $1 billion carve out of their $10 billion, right? So everyone's kind of approaching it differently. For us, we have our impact pool, we've got our diverse managers pool, we have our colleague that manages our ESG, and we all talk amongst each other. There are sometimes we're sharing deal, or we're looking at the same deal and deciding which part of the house it's going to be. But for the most part, the integration piece, I feel like, is really evolving.
Dawn, I wanted to go back to something you said at the start. You have a list of 1,000 funds about. How do you group those together? How do you kind of come up with this is an impact fund and this maybe not, maybe is on the line?
Yeah, so we don't pay as much attention to what a manager says if they self-identify as impact or if they don't. We have a proprietary theme mapping that we use that maps, it seeks to translate the Sustainable Development Goals from the United Nations into actual investable themes. And so we take a strategy and we can map it to our framework. Across 5 overarching themes and 22 sub-themes. So energy transition, natural capital, empowerment, health, and sustainable communities. And that allows us to kind of see is the thesis and what the underlying businesses that are being invested in, are those impactful and linked to these specific social or environmental outcomes? And then we layer on top of that an evaluation of the manager in terms of their sophistication in integrating impact into their investment process, all the way from establishing that thesis through to supporting the companies to maximize impact over their ownership, and then finally measuring those outcomes, which is super important. And so that's kind of how we define it, because there are a lot of folks out there who will say their impact, but they're maybe really generic theses that, like Greg said, everything has impact. They're just creating jobs. It's not necessarily with the intentionality. And so that allows us to be really specific about what we're talking about. Yeah.
And I did want to follow up. You mentioned it again there, the measurement aspect of it. And I'll ask everybody about this point as well. How are you seeing measurement coming through in impact investing? Is it standardizing so that you can go from fund to fund to fund and say, and kind of come up with a similar thing like we do with ESG scores?
Yeah, I think we're seeing more convergence in ESG land. We still have a ways to go in the impact space. What we seek to do is align those themes that I talked about before with specific metrics that are best practice, like the IRIS Plus metrics from the Global Impact Investing Network. And if a manager doesn't already identify the specific metrics, we can work with them collaboratively to say, I think these are the metrics that make the most sense. And that way we have a little bit more input and control into the process, so that when our clients who don't want a zillion different impact reports, they want to report on one clear or two or three clear metrics to their stakeholders, we can say we've played a part in the process of standardizing the approach to measurement, and they actually have something that's digestible coming out of it. There's a lot of nuance to this, so stories and all of that are still very important, but ultimately we have to be practical about trying to play our part in driving standardization, and also doing it in a way that makes sense for GPs and for companies, especially when they're at the early stage, right?
Cynthia, a question on measurement.
Yeah, I mean, for us, we just last year did a review of the portfolio, and we looked at our financial and our impact performance, and we got a bunch of recommendations. And so we have been updating the framework for our impact. So similar to what Don described here, we really have the managers tell us what they are most comfortable with, whether they are going to integrate into their process. It's got to work for them. We cannot tell them what to do. It doesn't work. And so for those that don't identify, we do put them in contact with like the GIN and others. And we've had a few managers where we just saw what they were doing and we're like, we see how this benefits under resource communities. Let's talk. And so, and in that case, we gave them some feedback. They talked to others. They integrated it in the way that made sense for them. But then we roll all of that data up into the kind of portfolio view for both our endowment and some of our programming work. And then we review that pretty well, annual at least, but we'd like to get to biannual. But as you can imagine, it's hard to collect this data, right? It's hard to synthesize it. And so I think that's the piece we're really eager to dig in on. We've got a fantastic data and evaluator on team that's helping us kind of navigate this, because this is like integrating, you know, what we're already doing on the investment side, but kind of starting to take all of these practices and figuring out what's going to stick.
Caroline, thoughts on measurement?
Very similar, really, where we take the data from the managers. At this stage, we're really trying to create our own standardization, but it is very difficult, particularly when you have different clients with very different projects and different interests in what they want to have measured at the underlying level. So it's really on a bespoke basis.
And Greg, how are you thinking about
the only thing I'd add, Patrick, is, you know, we've been in a sort of, you know, maybe Impact 101, thinking about how a measurement ought to be done in reporting for some time. I think where the field will go is really back to how to use that data with respect to tying it into company operations for the opportunity to have expanded and enhanced levels of outcomes driving. And I think today, a lot of the field has sort of still been perhaps in a place where it's a forced march through complying and just reporting, you know, for its own sake. I think there are levels that we're all trying to get to, and it especially puts companies in stronger commercial positions to really articulate why their methodologies or whatever it is that they're doing stand a chance to, you know, outcompete, you know, some of their contemporaries in the field. That all said, I actually think the entirety of the impact investing ecosystem does a better job at this than regular way investors. many of whom are not either tasked with it, don't know how to do it, don't have the personnel to do it, don't see why it's relevant that they should have to report it out. So I actually think we have a real opportunity here with measurement and reporting to really lead our respective asset classes. And I think this is a place where the broader community of investors can look to the impact community to point the way to the future. I really believe that.
Folks who are willing to ask the hard questions.
For sure.
No, I 100% agree.
Yeah.
Yeah,
Can I just jump in?
Please.
I think that the commercial value of impact metrics is so underestimated and under talked about. It's seen as a reporting burden for LPs, but if the managers and the companies who get it, they understand if I can tell this story and I can measure it, I'm going to win new business, retain customers. It's going to really resonate with my stakeholders. So I think Greg is totally right on that point, that we have an opportunity to lead and to really drive positive financial and social environmental outcomes with measurement.
Interesting, great. Greg, going back to something you mentioned before too, I mean, we've talked about some of the positive aspects of impact, but you also mentioned crosswinds, headwinds. How do you see some of the challenges facing the impact investing space going into 2024 here?
One of the most unfortunate things that I think has happened just in investing is how much culture wars have hit the conversation about how to invest capital. We've actually seen a number of asset managers really step back from their commitments or their core beliefs. I think what we want to see is a more full-throated, compelling, statement made on behalf of our philosophy, but not just that, but also our commercial results. And I think what I believe, Patrick, is there simply are not that many investment themes that when you look out over a decade that are more important than things like sustainability, or climate and energy transition, or what I think about in terms of the people issues related to, what I believe to be real stagnant social mobility. I think, people's life outcomes can be easily predicted by the zip code in which they're born. In other words, we actually live in a different country than the one that we think we do, which is the idea that every kid that's born has a high opportunity to be this thing or that thing professionally. The data does not tell you that. And I think the entirety of our economic output for really the last decade or more has been stimulated. And it's partly because, Patrick, we've sort of understood economic growth to be really largely by the measure that we trickle down opportunity from the top economic strata on down to everyone else. And it's broken. It has not worked. And I think to the extent that our country maintains economic preeminence, it has to be by the margin of more people gaining economic opportunity. To the extent that that remains broken, we will have no chance at sustaining economic growth. So it seems deeply intuitive to me, more than commercial. And I actually would put any of the themes that we think about investing in against any regular way investor all of the time. I think these are places where you can drive exciting returns. And I think to the extent that sentiment still is in many ways behind the fact pattern, that's been problematic. It's hard to fundraise when people question that. It's hard to appeal to LPs in the way that you would otherwise. But I want to stress the fundamental opportunity is so strong that I think we're really dragging the conversation into the future. But it's challenging sometimes.
Do you mind if I add to
Yes,
that?
please.
I think that really gets to this sort of long-term traditional assumption that impact investing had to be concessionary. And our clients won't make an investment in impact investing that is concessionary today. That's because they can't afford to make those investments, because they need to, in order to perpetuate, all our clients are endowments and foundations, I should probably say that. In order to perpetuate their mission, they have to be able to generate that CPI plus 5 return, or whatever it is their spend rate is. So they need to be able to make investments, impact or otherwise, that are achieving that return level. So they want their impact investments to have those returns as well as have the impact. It's a very high bar, but it isn't totally achievable. And that's the misconception.
Cynthia?
Yeah, no, I appreciate that point, because I think that's where our work is. We're the type of investor really to catalyze. And so we'll go into first-time fund managers, second-time fund managers, really with the intent to one, they have really promising, a promising outlook, but we also want to help them navigate the being an impact manager, whether or not they are explicitly or inexplicitly. So one of the other things, the nuances within this is that, with impact investing growing, and then the last few years post the George Floyd murder, and the conversation around DEI has created this incredible opportunity of managers, some of them who happen to be diverse, and then some of them who happen to be focused on impact. And so there's this interesting conversation going around, is it actually, is it a deficit to be labeled as impact? And we believe no, because we've seen managers across the spectrum. I mean, very good returns to those who are right in the middle, and then others who, it didn't play out. And we believe that there is space for all of that, but we're really, each one of us as investors and allocators need to be focused on what's important to us and how we will get there. So it's great to be able to work with a broader array of investors. 5 years ago, we didn't see a lot of the big, maybe just Goldman, but we didn't see a lot of the big asset managers out here. Now everybody's got a fund. We're seeing them all at the gin and all of this, all these impact-oriented and contributing in meaningful ways, particularly around data and all these insights that the folks are gleaning from the data as they kind of comb through what's actually happening. Because I think I'm waiting too, because I want to see what ends up happening with this performance and what that correlation or not between the types of impact and the degrees to which that impact is benefiting whomever you're targeting, whether it's community, your portfolio, or beyond. So.
And I'll just add very briefly, I think we've talked a lot about social impact on this panel today, but the climate opportunity is immense. It's actually the largest theme in impact that we see interest from our clients today, and where we see GPs raising capital around. Climate's a global problem. We see a lot of these strategies focused or based in developed markets and investing in really innovative technologies, so from the VC spectrum all the way through to buyout and on the infrastructure side as well. And I think the climate opportunity is incredibly diverse in its scope. The metrics are a little bit more straightforward because you're talking about GHG emissions and GHG emissions avoided, so it's very tangible for folks to get their hands around. And I think this is a theme that allocators want to be on the sidelines of if we look ahead to the next decade. Climate is both a horizontal and a sector, so it's kind of parallel to how we think about technology and how technology has really driven returns over the past 10 years, and as an allocator, you wouldn't have wanted to be on the sidelines of that. So we're really excited about the climate opportunity. We're not the only ones who have noticed how compelling it is, and therefore there's a lot of overnight experts out there, and it's that complexity between distinguishing, which managers are authentic in this space and are truly driving impact that we help our clients navigate and identify the best opportunities.
Can I just ask on climate, just to be a little bit more specific on that, like what themes, how are they doing impact in the climate space? I mean, is it picking specific companies? I know you mentioned it was both sector and horizontal.
Yeah, so we're talking about, the horizontal part is that every company has to navigate climate risk, and climate risk is a business risk. Those companies are often the consumers or maybe the acquirers of this whole suite of climate solutions businesses that are that have been started around, energy transition, everything from renewables to kind of the picks and shovels around the energy transition, natural capital strategies, ag tech, sequestering carbon from the soil. We could go on and on. I'd be happy to chat more about it.
Well, unfortunately, we are out of time. So Dawn, Cynthia, Caroline, Greg, thanks so much for participating this afternoon.
Thank you.